Hey, welcome to the exchange. In this video, I want to take a look at Affirm. They're wrapping up their fiscal year FY22 this month. Also, want to look at too is long-term default rates, also where the company could go in the near future. So this is the model of Affirm. What you're seeing right here is FY22, which we're in right now. It lasts till June 30th, so it's about to wrap up this month. I'm saying roughly right now $1.3 billion of revenue. So this is net revenue. So the actual total sales are roughly 15 or 16 billion dollars, but they take about a 6 or 7%, maybe 8% cut of that. And that becomes their net revenue. That's why it's much lower than their actual gross volume overall. Looking at year-over-year growth, roughly 53%, which they're calling for FY22. It will slow down dramatically in FY23 and beyond. So I'm saying here 31%, and I'm saying hey by FY28, roughly 18-19% or so revenue growth year over year. Now again, the revenue growth should hit about $4.6 billion by FY28, but we'll see what happens. So looking at operating expenses here, and they're a little bit different because they don't have a true cost of goods sold in their actual income statement here. So if you take your actual revenue minus your OPEX, you actually get operating profit or loss right there. It's a little bit different than most companies, but it's just the way they do it, which is it's not right or wrong. It's just a little bit different. And they have a lot of OPEX items. I highlighted a few of them that I think were kind of eye-popping. I mean, the number one obviously is a provision for credit loss there. This is actually accounting for potential defaults upcoming in the near future. I'm saying this year, I mean, it might be $250 million by, end of FY22. I'm saying FY23, it might be a little bit higher than that though too. Now it will drop, I think, over time a little bit just because right now we're in a very kind of, risk off period. Default rates are ticking up overall. So it's a kind of a risk off period in general. So if you're wondering why the provision for credit loss has gone up so dramatically, it's almost 5x versus FY21. This is it right here. So this is basically looking at the actual delinquent loan status, also charge-offs on the very top up here. So looking at end of FY21, which is June 30th, 2021, they had roughly, if you add all these columns up right here, $80 million of loans in some stage of default. Again, it goes from 4 days all up to 90 days plus right here. The revenue, or basically receivables base, is roughly $2 billion. So if you add all these up right here, divide by the revenue base, you get roughly 4% or so in basically loans in or some stage of default. If you do the exact same math in March 31st, 2022, basically fast forwarding 9 months, you basically get $150 million worth of loans on a $2.486 billion revenue base. And from there, all of a sudden you see, hey, 6% of loans are in some stage of default. So really a 50% increase in the course of 9 months. Now, it wouldn't shock me if by end of June, 2022, it should be roughly probably 7%, maybe even 8% potentially of loans in some stage of default. Now, one thing to notice here is that actual default does not mean, hey, write-offs or basically, just a write-off overall. Looking at this massive numbers right here, roughly $80 million, only $14 million were written off in 2021. Now, this has increased in 2022. We're already at $48 million, basically, of write-offs itself. And the big fear is also in this number just accelerates into summer 2022, and it goes $100 million plus of write-offs, which is basically a pure loss for a firm in general. So heading back to the model, I mean, looking at here, sales and marketing, I mean, it's almost 3x from FY21 to FY22. But I mean, look at the revenue base there. It's not gone up nearly that much. So, I mean, this has to slow down in the near future because this growth rate is just not sustainable for anywhere in the long term. Looking at G&A, which is general administrative, again, it's up about roughly 80% or so. Again, the revenue base, the growth rate is not nearly matching that. So this has to slow down as well too. Just because, again, same reason. It's just not long-term sustainable. But yeah, looking at total OPEX here, I mean, it's going to grow pretty dramatically. Now, the rate of growth will slow down over time, or it basically has to slow down over time. But again, the revenue growth rate is, looking at revenue here is $1.3 billion. I'm saying OPEX this year is $2.2 billion of basic cash burn. And that will basically be very, very consistent for next, roughly till FY27, FY28. I mean, it's going to be a long-term trend unless they massively drop costs, which they might do, but we'll see. So what's interesting here is this really last line, OPEX percent of revenue. So basically also saying the way the revenue is structured with no cost of goods sold there, it's saying, looking at here, is that for every dollar you bring in FY22, you're basically burning or giving away $1.70 or $1.67 in the FY22. Now this will drop over time, and I'm saying, hey, by FY28, they're probably gonna be break even. So hey, take in $1, burn $1 overall. But again, this is a long way away though too. There's a lot of things that could go wrong potentially in the next 5-6 years for a firm, obviously in the near future. Looking at operating profit or basically operating loss, I'm saying this year they're going to lose roughly about $900 million. Now there is some stock-based compensation baked into some of these numbers as well too, so it's not that quite as high as a cash burn rate. But again, it's going to be very negative. I mean, looking at here, FY22, FY23, almost exact same number. It will get better in FY24 because you're going to see this loan loss provision basically drop down a little bit there. So it actually basically like it's almost like profit in a way for accounting overall. But again, I'm saying even by FY28, they're going to burn roughly $100 million overall. Looking at other income down here as well too. This is money market funds. So it's basically interest they get on money market funds. Not really that important. It's very hard to project over time though too. So I gave them a roughly basically $50 million profit, from FY23 to FY28 there. Looking at income taxes there, and the very bottom line you see down here is net income loss. So I'm saying on a net income basis, we're going to lose about $738 million this year. And then probably same thing, or give or take next year. And then it should get better in FY24 and beyond. And again, by FY28, it should be right at a break-even company right there, which again, that is way down the road potentially. So last thing I want to show you real fast, this is from their investor presentations, kind of their like long-term outlook and kind of what their margins will look like overall. So right now they view themselves really in like hyper growth plan or hyper growth phase right now. So they're saying, hey, FY22, like basically revenue growth rate 53%, which that matches what I'm saying FY22 as well too. But again, they're saying, hey, long term though, the actual growth phase versus the hyper growth phase is only 20 to 30%. So I mean that they're going to get there maybe even next year. I mean this hyper growth phase ends in FY22, and FY23 to really FY26 is just their growth phase overall, which they're having growth, but it's not going to be like hyper growth like they describe it overall. Really, what's that mean though in kind of layman's terms? So they're looking at here the net revenue margin. So basically the percentage they take from the actual merchants themselves. Right now it's at roughly 9%. It will decrease to 8%. They're saying, hey, long-term outlook though is roughly 6 to 8%. So the actual net revenue base itself, it will decrease as a percentage of the gross payment volume, etc. So there is some good news though. So this is actually looking at their revenue less transaction costs as a percent of revenue. They're saying here they should have margin expansion. So the way they look at this is like almost like a cost of revenue in a way. So the lower this number goes, lower this percentage goes, the better it is for a firm. So they're saying in their growth phase as well as their long-term growth phase, this should drop maybe as low as 37.5%. So roughly right now they're at 48%. So again, the actual revenue growth rate itself might slow a little bit, but the margin itself should expand over time in the growth phase and the long-term phase overall. Now let's look at the actual basically elephant in the room. That's the Apple fintech announcement, which we knew was going to happen. We knew big tech was going to get in the fintech space more aggressively. And really for Affirm, the big fear for them is if Apple comes in, or even a Walmart or Amazon comes in, offers the same business model, but offers a much lower price point for merchants, where it's just much cheaper in general, where all of a sudden Affirm itself is wiped out by basic competitive pressures. Now you think about too, as a customer, for like customer loyalty itself, no one's really loyal to Affirm. I mean, really, it's almost like banking in a way. Whoever offers the best rates or the best credit cards, etc., that's where you're going to shift to over time. So really for Affirm, I mean, I'm looking at customer lifetime value here and customer loyalty here. I mean, it's going to be very, very weak in general if I had to guess. But again, we'll see. I could be totally wrong on that point though. But that's my big fear I have for kind of that 5-year plus time horizon for Affirm. Now, I did not do a full valuation video for Affirm itself. If you want to see a full valuation, drop in the comments down below, and I'll be sure to get that out pretty soon. Also, be sure to sub the channel in the corner right there. And if you're a current sub, hey, thank you very much for your support. But yeah, that's the exchange.